Larry Shover, Chief Investment Officer at SFG Alternatives, is joining us now live from Chicago. Larry, good afternoon to you. Thanks for joining us.
Good morning.
How do you sort of make sense of the fact that we saw GDP rising, we saw consumer spending in that read lifting, yet that sentiment read for November waning? Which one do we believe?
I don't think you believe any of them. I think they're all within the current narrative, and that's why the market is like as slow as it is and continues to, rally or sit at these highs right now. It seems like the participants, the market is very comfortable with the narrative, and neither of the numbers, also the earnings that we had this morning, none of them together really just changed the narrative whatsoever. So right now, everybody's just waiting for tomorrow's PCE report, personal consumer expenditure, and also in our Thanksgiving, we have OPEC. So that's what seems to be what people are waiting for.
The PCE, this is so important because of the deflationary pressures that are coming from around the globe. We're considering the falling oil price and the impact that that will have. But this is the measure of inflation that really is closely watched by the U.S. Fed, right?
Yeah, exactly. It seems like it's a little bit of a deeper dive than would be the CPI. Our volatility for our options are elevated today. It seems like participants, even though they're quite happy to see this market where it is, they are concerned that this number could be a doozy one way or the other. So people are protecting themselves.
So how are people protecting themselves?
Well, right now, at least in the equity market, you're seeing a lot of people buy downside protection, which would be buying out-of-the-money puts, whether they be 5 or 10% out-of-the-money puts, just to protect themselves against some type of downdraft like we saw back in October.
Okay, and when we come to strategy, I guess this week in particular, we have month's end, obviously, coming toward the end of the week, but that also falls around that Thanksgiving period. We've got the closure on Thursday, the half day of trade on Friday. So how will that sort of play into the psyche, play into the week's trade?
Yeah, it's a great question. I mean, as long as OPEC doesn't say anything or come to any kind of conclusion that's outside of consensus, I really believe it'll just be more of the same. It'll just be like watching paint dry like we've seen the last several trading days. It's one of those things where people are saying, not why is the market rallying, but why shouldn't it rally? I mean, economic data is good. Our earnings season's been decent. Central banks continue to be very accommodative, especially when we look at Japan. Europe, I mean, Draghi's going to have to do something, and it appears a lot more likely that he will. So it's just keeping stocks much higher than they probably deserve to be.
Okay, so, when we look for, I guess, areas of interest then in the market, we continue to see the oil price coming off. I guess one thing is that it could lead to some M&A in the space. It could also lead to, I guess CEOs have to become more creative when they're being pushed against the wall. Yeah. So do you take a look at, say, the energy space in particular and start looking for value in there, Larry?
Yeah, I mean, definitely could, because right now, between October and here at the end of November, the energy sector in the equity market is the highest short market in the United States. So it's very, very vulnerable for some type of dead cat bounce, even if people are wrong, because there's so many shorts in the market. That's being offset by record longs in the material sector in the stock market. So, if you want to play contrarian and get a little bit of an edge, a great time to get into the energy sector because there's so many shorts pushing down prices.
Why do you think that the materials space is the least shorted?
Well, I think relative to the energy, I think a lot of people think that the materials sector is going to do well, that we're going to see global growth starting to pick up and maybe to stave off disinflation just a little bit. So relative, when we're looking at like the infrastructure part of the energy market, those securities tend to be owned versus the straight out energy which people are selling.
And when you look at, I guess, what's to come, we've mentioned Thanksgiving, the OPEC meeting. Beyond that, though, next week is going to be a pretty interesting one as far as getting a greater handle on that growth story, at least in the United States and, I guess, in Europe, because we do have that ECB meeting coming up as well. So is that sort of the next real risk event that you're looking towards?
Yeah, I personally am, and this is the first time I've said it, I mean, I think ever, but I would be overweight European equities, especially cyclical stocks right now, versus the U.S. I'm not saying to sell the U.S. stocks, I'm just saying relative, and I would hedge my exposure by being long the dollar, because I think there's so much pressure on Draghi at this point. A year and a half ago, I would never believe that he'd be able to pull off like a Japanese-style quantitative easing, and I still don't think he'll be able to, but maybe something close to it, buying non-corporate bonds. Who knows? But I do think it'll be very good for their stock market, and looking at their cyclical stocks being just down in the dumps so much, just a great buy relative to the U.S.
Well, and speaking of Japan, I mean, the Nikkei has been such a standout market as well. Do you see any value there? Are you moving into, Japan? How do you view it?
Yeah, and actually Japan is first. I mean, I think relative to the U.S., I would be well overweight Japan, and also hedging my exposure by being long the dollar against the yen, because we have seen already that the Bank of Japan is deeply committed to doing whatever it takes right now to combat the problems they're having. So with that in mind, it's a natural edge to be buying equities like we saw in the U.S. So yeah, clearly I would be overweight Japan first, second by Europe, offset by the U.S.